Dear aspirants, welcome to the Lucid Mains Current Affairs program brought to you by Neo IAS. Today, we will be studying an extremely important topic both from GS Paper 2 and GS Paper 3 perspective. The topic is RBI and its functional autonomy. The issue has become a hot topic of debate due to a speech by Viral Acharya, a deputy governor at RBI. He said, governments that do not respect central bank independence will sooner or later incur the wrath of financial markets, ignite economic fire, and come to rue the day they undermined an important regulatory institution. He stands for functional autonomy of RBI, and his speech indicates the fueling tensions between RBI and the government. Now, before dealing with the major aspects of the issue, we will look at the major functions of RBI. Primarily, it is the monetary authority. In this capacity, it formulates, implements, and monitors the monetary policy with the objective of maintaining price stability while keeping in mind the objective of growth. In this context, Monetary Policy Committee with the mandate of inflation targeting is to be noted. This committee is to ensure price stability. Secondly, RBI is the regulator and supervisor of the financial system. In this capacity, it maintains public confidence in the system, protect depositors' interest, and provide cost-effective banking services to the public. Thirdly, it is the manager of foreign exchange. By managing Foreign Exchange Management Act 1999, the act is enacted with the objective of facilitating external trade and payments and for promoting orderly development and maintenance of foreign exchange market in India. Fourthly, it is the issuer of currency in India. And then there are important related functions like banker to the government and banker to banks. As a banker to the government, RBI performs merchant banking function for the central and state governments. A merchant bank is a bank dealing in commercial loans and investment. Example, raising finance for clients, in this case, central and state governments. RBI as a banker to banks, it maintains banking accounts of all scheduled banks. In this role, RBI helps the banks in times of crisis by extending credit. Okay, now we will discuss about the conflict points between RBI and the government. The first one is that the RBI has put 11 public sector banks under lending restraints on account of a high level of bad loans. That is through prompt and corrective action, PCA. Then what is PCA? By which the RBI generally restricts lending activities of the banks. Banks under this framework are restricted from opening new branches, staff recruitment, and restricts the amount of loans banks can extend. It will affect credit supply, particularly to MSME, which has huge employment potential. But on the other hand, bad loan crisis or NPA is threat to the whole economic system. The next is the issue related to liquidity squeeze. The government is upset that the central bank is not doing enough to ease the ongoing liquidity squeeze in NBFCs after the collapse of Infrastructure Leasing and Financial Services Limited through extraordinary measures. This affected lending to MSME. In this context, we will learn an example for what is extraordinary measure. Before that, we will know some basics. Banks maintain a portion of their deposits as statutory liquidity ratio in the form of government securities that are highly liquid and can be easily sold to raise money. From January 2015, Banks were also required to meet the guidelines on minimum liquidity coverage ratio set out under Basel III norms. The main objective of liquidity coverage ratio is to ensure that banks maintain sufficient liquid assets to meet obligations in a 30-day stress scenario. Okay, now we will deal with the extraordinary measure undertaken by the RBI in this context. As banks have to maintain such liquid assets over and above the mandated SLR requirement, the RBI has allowed banks to dip into a portion of their government bonds held under the mandated statutory liquidity ratio, held under the mandated SLR requirement to count as liquid assets for computing liquidity coverage ratio. So, banks can borrow funds against these bonds to meet the liquidity requirement of other players such as NBFC. So, this is an example for extraordinary measure. Many similar measures can be initiated by the RBI. Next is RBI's demand for higher capital requirement norms which goes beyond Basel III guidelines. The Basel III norms stipulated a capital to risk weighted asset of 8%. However, as per RBI norms, Indian scheduled commercial banks are required to maintain a CAR, that is capital adequacy ratio of 9%, while Indian public sector banks are emphasized to maintain a CAR of 12%. The capital adequacy ratio measures a bank's capital in relation to its risk-weighted assets. The capital to risk-weighted asset, the capital to this CAR promotes financial stability and efficiency. The government demands to bring down the capital adequacy ratio in line with the bare minimum levels prescribed by Basel III norms, that is 8%. But in the recent board meeting, RBI provided another year of implementation of the capital conservation buffers. Then, as per February 2018 circular by the RBI, if a borrower delayed payment for even one day, he should be dragged to an insolvency court and the asset be classified as non-performing asset. This stringent circular has caused tensions between RBI and the government. So, now we will look into the need of autonomy for RBI. To ensure macroeconomic stability, a strong RBI is a must. There are serious threats like foreign portfolio outflows due to higher interest rates in the US and escalating trade war between the US and China. Hence, a powerful RBI is a prerequisite to contain such challenges. Next is to maintain currency stability. In the context of the rupee being Asia's worst performing currency this year, RBI has to focus on long-term goals in the interest of economy, while many a times government is constrained by short-term goals like political necessities. And fourthly, as pointed out by Viral Acharya, the erosion of RBI's operational autonomy affects investor confidence in financial markets. Thus, it will affect investment ecosystem, in turn affecting growth. Now we will see how the autonomy of RBI is being affected. The first one is through RBI reserves. The government is demanding a higher portion of RBI reserves for transfer to government treasury. In this context, why RBI keeps reserves? It keeps reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country. The government believes that the RBI is holding excess reserves and a part should be transferred to it. However, the RBI is of the view that it needs reserves to attain its policy objectives. Nextly, in case of public sector banks, the RBI faces constraints in the regulatory framework as well as in implementation of the regulatory decisions. Example, in case of divestment, replacement of management and boards, license revocation, etc. Next is the epic transgression of the autonomy of RBI. That is the attempt by the center to set up an independent payments regulator. Currently, payment and settlement systems in India are covered by Payment and Settlement Systems Act 2007 and regulated by the Reserve Bank of India. The next is the ultimate weapon in the hands of government, that is Section 7 of the RBI Act 1934. The central government may from time to time give such directions to the bank after consultation with the governor of the bank in the public interest. This direction is binding on the RBI. By this powerful provision, government can issue any direction in the public interest. Some media reported that the government may invoke this provision. Now let us deal with the criticisms against RBI. One is that poor regulation, which resulted in fraud at Punjab National Bank. Next is the criticism that the powers over PSB is inadequately used. Despite RBI having nominee directors on bank boards as well as physical inspection at banks and financial audits. So now we shall see the examples for cooperation between the government and the RBI. One is inflation targeting, where the government sets the target and leaves it to the bank to achieve it. This should end conflicts over interest rates, as the governor is no longer the sole decision-making authority. Then what is inflation targeting? It is a monetary policy regime in which a central bank has an explicit target inflation rate for the medium term and announces this inflation target to the public. The Monetary Policy Committee of India is responsible for inflation targeting. Next is the stopping of the automatic monetization of government deficits. Now let us understand what is automatic monetization. The origin of automatic monetization can be found from the agreement made in 1955 regarding creation of ad hoc treasury bonds, ad hoc treasury bills between the central government and the RBI. This agreement specified that the central government shall maintain a certain minimum cash balance with the RBI, and if the balance falls below the minimum agreed limit, the account would be automatically replenished by the creation of ad hoc treasury bills in favor of the RBI. Over time, issuance of such ad hocs became a continuously increasing means of financial support to the central government from RBI. As rising monetized deficit has implications for price levels, the central government and the RBI felt the need to limit such credit extension. As a result, an agreement was signed in 1994 to phase out the creation of ad hoc treasury bills. That's about automatic monetization. Then introduction of FRBM, that is Fiscal Responsibility and Budget Management Act, is a good example of cooperation because it is introduced after meaningful deliberations between the RBI and the government. Now we will look into the outcomes of the recent RBI board meeting. The first one is that the board, while deciding to retain the capital to risk weighted asset ratio at 9%, agreed to extend the transition period for implementing the last tranche of 0.625% under the capital conservation buffer by 1 year. This measure will be a short-term relief to banks and will pump more money into market. And we have already covered about capital adequacy ratio, so not explaining that here. Next is the issue of easing the prompt corrective action framework for big banks has been referred to a committee. And thirdly, there is no consensus on addressing the liquidity shortage faced by NBFC. Instead, RBI announced that it would inject rupees 8,000 crore liquidity through purchase of government securities through open market operations. This is a good measure. And the RBI decided to set up an expert panel to examine the economic capital framework of the central bank. This will address what constitutes adequate capital reserves for the central bank. Next is that the RBI will consider a scheme for restructuring of stressed standard assets of MSME borrowers with aggregate credit facilities of up to 25 crore. This is a very much needed step. So, we will move on to the last phase of learning. That is way forward. The first and foremost consideration should be for effective communication between the regulator and the government, that is RBI and the government. This can resolve many conflicts. Even November 19 board meeting is an example of effective communication. Next is that the RBI can ease liquidity through extraordinary measures in addition to routine open market operations. We have already discussed this point. So moving on, that is the operational autonomy for the RBI in monetary policy, debt management and exchange rate management is must in the national interest. There can be no compromise here. In this context, Y.V. Reddy, a former governor of RBI, popularly observed that my single objective is to protect the Indian economy from the government of India. Nextly, insolvency and bankruptcy code to resolve bad loans to be properly implemented so that liquidity crisis can be addressed. Next is RBI should be granted more authority to regulate PSB, public sector banks. In addition, creating a government bank holding company that permits a series of board and management changes in PSU banks is a good option. In this context, P.J. Nayak committee's suggestion to set up a bank investment company under Companies Act 2013 as a core investment company assumes importance. Next is that the RBI should relax PCA norms, that is prompt corrective action. It needs to be less rule-based and more discretionary. A case-by-case approach with proper oversight can be adopted. So, dear friends, that's all about the topic. Thank you for your patience.